Okay, so we're going to go ahead and get started, gang. Barrett Ersek here. Thanks for joining us on this webinar. If everybody's ready to get started, we'll go ahead and get started. So today's webinar is about your P&L, but specifically about your P&L. What I want to talk to I want to talk to the context of using your P&L to grow your business and how to really kind of understand how fast you can grow your business. And some of the levers that you can kind of work to grow your business more quickly, and to make sure that you don't run out of cash while you are growing your business, which is certainly a challenge sometimes. Before we get there, and we're going to be talking pretty 101 stuff here if anybody has a finance background. To me, I'm not trying to teach you guys accounting. What I'm trying to teach you is some basic marketing concepts around using a lawn care P&L to grow a business. So let's just take a look at this video real quick, just to kind of get things started. It's just kind of a cute perspective of a 4-year-old and what he thinks about finances.
$59. From a 59-1 store. $150. Gotta get change, big change, and then you get big money, and then you go over and get a house. I'm gonna live in a brand new house far away. Yeah, where you can't even find it. It's gonna be really far away. But it's gonna be like our house. I'm gonna put decorations up, and I'm gonna put the tree up, and I'm gonna put my decorations up. You gotta get little change, little money, and then you stick it in your pocket, and then you just get a fast car.
All right, so clearly I wasn't trying to do a commercial for those guys, that financial company, but I just wanted to kind of illustrate, kind of sometimes, if we think about our employees, they may not be a whole lot more sophisticated than that guy sometimes when it comes to our finances, and they don't totally get, what it takes to run one of these businesses. They think, sometimes our employees, I've found, they see us leave an invoice for $150 to do somebody's lawn, they think we're getting $150, and they don't quite understand that there's a lot more that goes into it. So I just thought it was a kind of a cute little example. So that was just kind of like our preamble. But to get started here, we're just going to go through some basic 101 stuff, just so we have so we're all talking the same kind of words and the same language. And then really going to get into key metrics, understanding how to grow your business, and then we'll open up the discussions if anybody has any questions. So we're talking about the P&L statement, the profit and loss statement. It's also known as the income statement. You may hear your accountant or your financial people talk about it, in either term. You can also hear referred to as a statement of earnings, statement of operations, all the same thing. It's all about keeping track of how many dollars we got coming in, how many dollars we got going out, and what's left over at the end, which we hopefully have, and that would be considered profit. So let's think about your P&L statement in an average lawn care company. Now I'm going to just we may have people on the webinar that do mowing, that do landscaping, that do full service. I'm going to speak primarily to people who are only doing fertilizer, weed control, spray operations, chemical treatments, or Holganix treatments. I'm not going to speak to the ones who really are running the mowing and the landscape design build. You'll think about this. You'll separate out your P&Ls as your one side of your P&L is around landscaping, design, build, mowing, and then think about your P&L as it relates to just your lawn spray division, because they're really different P&Ls. And so to treat them all the same is probably not the smartest thing, because you need to make different decisions for those different types of P&Ls. So we're just going to talk about the lawn spray company. And so I'm going to just go through some really simple sample numbers. If these don't relate to you, it doesn't mean you're not running an appropriate business. There are many different ways to run your business, on how you charge per 1,000 square feet, on what kind of products you apply on the turf, on what you pay your employees, how far apart your lawns are. There's a lot of variables that go into this. So I'm just going to use some real generic examples that I found as I've spent lots of time in the industry dealing with lots of different companies. On general, we look at our, let's say we go out and we bill $100,000 for lawn care services, and we spray $100,000 worth of accounts throughout the year. You want to look at what are the direct costs associated with doing those accounts. And when I say direct costs, very simply, what I'm talking about is the cost of your fertilizer, your chemicals, obviously your Holganix, whatever you're putting into your tank, whatever you're applying onto that lawn would be part of your direct costs. Typically, 20% is kind of a good number that people like to shoot for. Some people are as high as 30 and 35% on the fertilizer and chemical costs, and some people are as low as 15%. So it does vary wildly. But my experience is the guys that are targeting that 20 to 25% range are guys that are really trying to keep a kind of a lean, a very profitable company on a cost of goods basis. And again, it really goes back to how much you charge them per 1,000 square feet. You can fix your numerator or your denominator. One way to change your percentage of cost of goods, your fertilizer and chemicals, one way is to pay less for fertilizer and chemicals by beating up your suppliers, hopefully not your Holganix supplier. Another way to charge less to reduce your cost of goods is to put down kind of lousy, cheap materials that don't cost very much. But at the end of the day, if you do that, you may not have your customers for very long, and so then, what good's making a profit on a customer for 3 months in a row, but not to have the customer in the 4th month because you don't do a good job. So obviously, there's a lot that goes into this. The other piece of the puzzle is how much do you charge per 1,000 square feet? Obviously, if you're for a 10,000 square foot lawn, you're charging $57. You're going to have a different chemical cost on a percentage of revenue than if you are charging $71 for 10,000 square feet. And by the way, 57 to 71 is kind of a big differentiation, but yet I see lots of lawn care companies in the 50s and lots of lawn care companies in the 70s for a 10,000 square feet lawn. So you just have to decide where you want to fit into that structure and that cost structure. But if you don't think that your cost of goods is the right percentage, then I would challenge you to evaluate what's going into your cost of goods from a fertilizer chemical basis, but probably also, and probably more importantly, I'd challenge you to look at your pricing structure to make sure you're getting, kind of market pricing. And I'll tell you that when I had a lawn care company, we used to raise our prices anywhere from 2 to 4% every single year, and very seldom would a customer ever complain about that. I'm not saying never. We did get people complain, and when that customer complains, you can always give them last year's pricing and tell them they're special, and you'll keep them at last year's pricing. But let's face it, if you right now are charging $100 and you can raise their prices by 4% and charge them $104, that extra 4% goes right to your margin. And so if you're looking at the cost of goods and you think, 25% isn't a good number for me, I'm a little higher than that. One way to fix that is to raise your prices. You raise your prices 2 or 3 or 4%. That goes immediately and directly to reducing your cost of goods as a percentage of revenue. So once you look at your fertilizer and chemical costs, then you want to look at your labor costs. That's still part of your direct costs in fertilizing that lawn. You've got fertilizer, chemicals, you've got labor. Your labor can run, again, that can vary wildly as well. Density is going to be a big factor in how much your labor goes into doing your lawns. So let's say if you have lawns that are spread out and you can only do 10 lawns a day, and it costs you $100 to pay somebody to go do those lawns for your technician, then obviously you would have like a $10 per lawn cost, and you better off to break it out per 1,000 square feet. But I'm just keeping things simple. If we could take that same technician and have him do 20 lawns because they're all right next to each other, then obviously you take that $100, you spread it out over 20 lawns, and now we've got only $5 a lawn in labor. So it can vary wildly, but I see anywhere from 10 to 20% in labor costs associated with your direct costs. And again, how much you charge per 1,000 square feet is a big factor in this. And then the last cost that you want to put into the equation is what does it cost you to have your truck, your equipment, everything that goes into getting that lawn done. So the van or the pickup truck, whatever it is that gets out to the property, the sprayer, the spreader, whatever else you've got that's going to get that lawn done. So what do those things cost? And usually we amortize those items over several years, 5, 7 years, whatever your accounting standards are. So you have a depreciation number that you associate with your equipment costs, and then you have fuel. So obviously you need fuel to get out there. You need fuel to run your sprayer. So those are going to be other items that go into your cost of goods. So at the end of the day, your cost of goods or your gross profit. So your gross profit should be in the neighborhood of, I would say, 50 to 40% gross profit, and sometimes I've seen them as much as 60%. So let's say 60 to 40% gross profit, and we could flip that around and say 60 to 40% should be your cost of goods. So that's kind of your biggest number that they're variable expenses for the most part. You can improve them by getting better density, better productivity. You can improve them by raising your prices. You can improve them by lowering your costs. Obviously, this year it looks like fuel is going to be lower, so that's going to be a plus to your P&L. But at the end of the day, those kind of costs, you're not going to get away from them. You can just kind of tweak them a little bit. They're variable, so the more lawns you get, the more that of those expenses you're going to have. And so let's just use a real round number and say 50% of our total dollars billed goes to pay for the direct cost of getting that lawn done. That means you've got 50% gross profit left over. And the gross profit, that doesn't mean you put it in your pocket yet. That means you get to use your gross profit to pay for your overhead items. So this would be things like insurance. This would be things like your office, your secretary, if you have any salespeople, marketing expenses, all of these other things that you reinvest into the company from that gross margin. You've got 50 cents or 50% left over to reinvest into those things that we call them below the line or below the gross margin line. And this is part of your overhead costs. Sometimes these are fixed, sometimes they're variable. When I say fixed compared to variable, so let's think about it. A fixed cost would be something that you have that cost every month, no matter what, no matter how many customers you have. And that might be something like your office and your warehouse. So let's just assume that you're not going to add more offices and warehouses. You're just going to keep getting more customers associated with that single office, that single warehouse, up until some point. You can do 100 lawns out of that office and warehouse, or you can do 1,000 lawns or 10,000 lawns. Your office and warehouse expenses may not change. You know, if it's $2,500 a month, it's going to be $2,500 a month every month, regardless of how many customers you have. You know, if you have a secretary or somebody that's answering the phone, again, that's somewhat of a fixed cost. You're going to have, you know, a single secretary, single person answering the phone for some number of customers. Maybe it's 400 customers or 500 customers. Then you may need to add a second one. So it's not totally fixed. It's more like a stair step type of a number. You know, your insurance is going to be somewhat of a stair step. That's going to be variable based on revenue, based on payroll. But you can understand that you've got your cost of goods and your gross margin, and you've got your expenses below that. When it's all said and done, you know, a lawn care company should be making anywhere from 4% up to maybe 25% on their total P&L that I've seen. And the reason those numbers vary so wildly is because you've got so many different situations. Some people invest a lot of money back into their company to continue to grow it, where others, you know, want to just kind of maintain their customer base where it is, and they want to take as much money out as they can. Certainly, if you've got a much larger organization, you probably have a lower percentage of profit margin because you've got more overhead, more people helping you run it. You might have managers and salespeople. Where if you're a one-man show or a three-man show, you can probably have a much higher percentage of profit because you're doing a lot of the job yourself. So you're saving some of that overhead. But at the same time, your overall number, your top line revenue number, may not be as big because how many dollars can you produce when you're a small organization? So if you're doing $250,000 in revenue, you may be looking at a 25% gross margin, where if you're doing $2.5 million in revenue, you might be quite happy with a 10% gross margin. Again, you've got more expenses that are flowing through below the gross margin number to kind of support those businesses at the higher numbers. But 10% of 1.5 million is obviously you know, more money than 20% of 250,000. So you just have to decide what kind of business you want to run and how those numbers kind of fit in. But what I really want you to understand today, because you know when I find that I go through these numbers, a lot of this is stuff your accountants can do, and it's pretty one-on-one stuff. But where I think people get confused is when they talk about investing money into their business for sales and marketing. How much money can you invest into your business for sales and marketing, and how quickly can you grow your business? Really, you can grow your business as big as you want to. There's just two factors that are involved in growing your business. One is time and one is money. And if you have more money to invest, then you can do it quicker. If you have less money to invest, then it's going to happen more slowly. And you know what I like to do is look at having your business and your gross margin support the growth of your business so that you're not taking money out. I don't want you to go out and mortgage your house and put it into sales and marketing dollars unless that's something you want to do. I'd like to see you use the money from your business to grow your business. And so if you can think about it a little differently, then I think you can probably do that. It's certainly some of the things that I've done over my career as I've grown my businesses, my lawn care businesses, with money that the business generates itself. So the key metrics to consider when you're doing this, first of all, I'm going to talk all about gross margin and kind of the above the line costs. So the fertilizer, the chemicals, the labor, the fuel, the truck. They're the only costs that I care about. And the reason they're the only costs I care about is because for the most part, and there's exceptions to this. Okay, I'm being relatively simplistic, but I think you guys are all smart enough to understand the differences and how to kind of tweak this for your business. But if you think about the expenses above the line, the fertilizer, the chemicals, the labor, the fuel, the truck, the more customers you get, the more those costs you're going to get no matter what, for the most part. And so if our gross profit is 50%, that means our cost of goods is 50%, then no matter what we do, we're never going to get better than 50% additional contribution margin. Let me just back up for a second and explain contribution margin. So when you get your gross profit of 50%, that's considered contribution margin. That contribution margin then goes to pay for your overhead and all of the expenses for your office and your warehouse and your secretary and your marketing and all those things. So what I want you to think about here is, let's just assume that you have 250 customers right now. And at 250 customers, you're paying your bills and you're relatively happy. Okay, the business is supporting your life, and that's working for you. And maybe the number isn't 250, maybe it's 2,500. It really doesn't matter. Let's just say 250 for an example. So let's just say 250 customers is the number that it takes for you to run your business and support your life. Well, if we were to go to 400, or let's say 500 customers, so double that. What I'd like you to consider is that when you go from 250 to 500, every one of those customers that you bring on from 250 to 500 generates 50% gross margin or contribution margin with the assumptions that we're making. And so every one of those customers is going to generate an additional 50% of the bill that you leave is going to come back to the company. And I'm going to assume, and this is simplistic for me to say this, but I'm going to assume that all your other expenses are going to pretty much stay the same. That's not absolutely true, but it's kind of largely true, especially up to certain growth hurdles. It'll be more like a stair step. So you will actually incur additional expenses along the way. But if you go from 250 to 500, if we just use that example, there's very few expenses that actually dramatically go up from 250 to 500 besides fertilizer, labor, truck, fuel, and chemicals. All the other expenses are pretty much going to stay the same. And so you can really look at that and say, okay, 50 cents out of every dollar I'm generating is indeed going to pay for gross margin, is really a contribution to my overall available cash that I have. Now that assumes that the people are paying their bills, of course, and it assumes that you don't lose a whole bunch of customers. So that's other factors that would go into this. So we've got the contribution margin, we've got the gross margin. The other things that we want to think about, we've talked about COGS, cost of goods sold. So that was that gross margin, and that's the fertilizer, chemicals, labor, fuel. So that's also called COGS. The gross margin, we've talked about that. And the way to get your percentage of gross margin is you take your total cost of goods, dollars, divide that by revenue, and you get your percentage on a percent of revenue. So that's where I get my 50% gross margin. But it goes deeper than that. It's really easy to just sit there and say, I make 50% gross margin on every one of my customers. One of the things I've learned is that absolute statements are absolutely never true. And so to sit there and for you to say that I've got 50% gross margin for every customer that's on my program is not reasonable. And so what I'm going to suggest is that there are customers that are more profitable than others. And if you look at the customers that have the highest density to your customer route, let's say you have 3 customers on the same street, you're going to make a lot more margin doing another lawn on that street than you would if you were to pick up a new customer on some new street somewhere else. And so when you say 50% gross margin as an average, that's not really accurate because that's only for an average. But there are some customers you probably make as much as 70% gross margin, and other ones you might even lose money on. And so it's really important to understand who your most profitable customers are. And we have a term at Holganix that you may or may not have heard called the Golden Street Strategy. And you can look this up if you go to the Holganix website. You can download a 7.5 Secrets to Growing Your Lawn Care Company, and we have a whole write-up on Golden Streets. But the Golden Street Strategy it's pretty simple. You know who your Golden Streets are. It's the streets within your marketplace that you have a couple accounts on. Typically, they're 50, 80, 100 homes in the subdivision. Typically, the subdivisions are relatively new, like in the last 10 years or so. They're relatively affluent compared to other houses in your area. Not the most affluent, not the nicest and richest, but kind of upper end. And it's these subdivisions where everybody gets their lawn done by somebody. If they're not, they're doing it themselves. So everybody's got a nice lawn. Everybody kind of looks the same. They're cookie cutter McMansion. You get the concept. These golden streets are important to understand because if we're going to spend sales and marketing dollars, we want to make sure our sales and marketing dollars are getting spent to go get customers that are going to get us our quickest return on our investment of our sales and marketing dollars that we've invested to get those customers. And so that's going to be our golden streets. And so if you can think about the golden street, we have three houses on a street, but you'd like to get maybe 7 or 8 or 9. Those incremental extra houses you're going to get on those streets are going to come very, very profitably. The incremental labor that you're going to need to go from doing 3 homes to doing 4 homes is almost nothing. I mean, most of the labor is just getting the truck out to the neighborhood. Once you get the truck out to the neighborhood, to go do one more lawn takes you, an extra 6 minutes or something. You do have a higher fertilizer and chemical cost, but that's only 20 to 25% of the total bill. So that leaves us with 75% to still play with. We're going to save on labor. We're going to save on fuel. We're going to also get more lawns done with our truck. So we're going to save on our depreciation and how many lawns that truck can essentially service. As a result, it's less cost per lawn to pay for the truck. So the more lawns we can get done in a day, the less windshield time we have, the less ass time we have driving around from house to house, the better we're going to do, the better margins we're going to make. The secret to this is golden streets. So if we take it and now we want to look at what's our ROI, return on invested dollars. So you want to look at sales and marketing as an investment into your company. And the only real question is, how long does it take for that investment to come back to me? So when I put the bread in the water, how long does it take for that bread to come back to me in the form of fish? And so that's what our return on invested marketing dollars is. Now there's some variables that tell you how quickly you can get your return on your invested marketing dollars. So the first variable you want to think about, which we've spent a lot of time talking about already, is gross margin. So what is your gross margin? So if we used our example of 50% gross margin, let's just use an example of a customer. Let's say our customer pays us $500 a year to do their lawn, and we get 50% gross margin. Then that leaves us with $250 of profit, gross profit, not net profit, that we can use to help offset our marketing costs. Now, again, I just got to do a real quick exception here. I am assuming that you've already got a business that's already paying your basic bills, that's already supporting your life, and every customer we're getting you is going to just add incrementally to your overall revenue, and ultimately will increase your profit to your company, but it may not do it right away. And so your gross margin, if you're doing $500 revenue per client, your gross margin is $250 at 50% gross margin. If you spent $250 to get that customer in marketing cost, it would take you 1 year to recoup your marketing investment to pay for that customer. If you kept the customer for 5 years, then you would have a lifetime value of that customer of 500 times 5. So that would be $2,500 total revenue. 50% gross margin would be $1,250 total contribution margin over the lifetime of that customer. And if you were to spend $250 in marketing costs to get that customer, to get $1,250 in return in contribution margin, then that's actually not a bad story. You recoup your money in 1 year, and then every year after that, you make profit. If you can afford to go for 1 year without making a profit on that customer, then I would tell you that math works. But now let me give you another scenario. Let's say you only make 40% gross margin on that same customer. So now your contribution margin is $200. 40% of 500 is 200. So if you were to spend $250 to get that customer, but only have a 40% gross margin, then it may take you 14, 15, or 16 months to get your return on your marketing dollars. So it's going to be a longer return. Still might be worth doing, but just know that you're going to be waiting longer to get that return on your marketing dollars. Now let's assume you could do a 60% gross margin. 60% of 500 is $300. And so now you've got a $300 contribution margin in year one, cost you $250 to get that customer. You've actually paid for that customer and made a $50 profit in year one. That's a pretty good story. And so my general rule of thumb is I like to look, assuming that I'm already paying my bills with my basic business, I like to look at, and you don't have to pick this as your numbers. This is what I like to use, and you got to decide what's right for you. But I like to look at it and say, if I can pay for that customer in 1 year with my marketing dollars, so I take my gross margin and I take my cost per sale cost, which I'm going to get to in a second. But how many dollars does it cost me to get that client, and I can pay for that client in 1 year with my gross margin, then I'm pretty happy to get those customers. And in fact, I'll take as many as you got. Now you got to figure out how to cash flow them, and you got to figure out how to pay for them, because sometimes you got to put the money up first and then get the customer afterwards. But as long as I can solve that immediate cash equation, and as long as I can get that money in return within 12 months, then I'm pretty happy with that scenario. So gross margin affects your marketing return on investment, okay? The other thing that affects your marketing return on investment is your cost per sale. Now, cost per sale is going to vary wildly from market to market, from company to company. I used an example of our cost per sale of $100. Now, I'm not saying $100 is the right number. $100 is actually a pretty darn good number. If you have a cost per sale of $100, then I would say do as much of that. I would get as many $100 cost per sale customers as I could possibly get, especially if they're the right customers. But again, remember, not all customers are created equally. So if I spend $100 to go get a customer that's 30 minutes from any of my other customers, and I make a 10% gross margin because it costs me so much in labor and gas to get to that customer, that might not be as good of a story as if I spent $200 to get a neighbor of an existing customer, where I'm going to maybe make 60% gross margin and get a return on that customer quicker. So you've got to look at cost per sale. You'll hear a lot of people in the industry talk cost per sale. And I do hear guys say $100, $120 is kind of like a really sexy target that they like to shoot for. And my instant reaction back to them is, well, it just depends on what kind of customer you're getting. It depends on how long the customer lasts. It depends on how close the customer is to your other customers. It depends on how profitable that customer is. Not all customers are created equally. So make sure that when you look at cost per sale, you're talking about the right kind of customer that's going to give you your right return on invested dollars. So if we use an example of a cost per sale of $100, how do we get to that cost per sale? Well, it's very simple. One of the things that goes into cost per sale is our cost per lead. So let's think about a lead. What is a lead? So a lead is when the phone rings and somebody asks you for an estimate, how much does it cost to do lawn care? The question is, what did you do to get that lead? Sometimes we do nothing. We just show up to our neighbor's lawn, to people's lawns, and their neighbors call us because they see our truck and we do a good job. That cost per lead could be zero. But then we have things that we do like Valpak, or we might do internet Google Words, or we might do Angie's List, or we might do direct mail, or we might do telemarketing. So what you do is I would, first of all, I think it's very important for you to separate out your different marketing vehicles. So if I did Valpak, I would want to know how much money did I spend in Valpak and how many leads did it generate. That'll tell me what my cost per lead is with Valpak. Then I would do direct mail, and I would say, okay, how many dollars I spent in direct mail and how many leads did that generate? And that'll tell me my cost per lead with direct mail. And obviously we can do that with every vehicle that we would have in an advertising bucket. Cost per lead is only a piece of the puzzle, though, because let's say we had a cost per lead of $33. We did our Valpak advertising. It cost us $330, and we got 10 leads. So that would be $330 cost per lead. The next question is, really, cost per lead is only a piece of the puzzle in figuring out cost per sale. And until we get to cost per sale, we don't really understand whether that was an effective vehicle or not. And that goes into conversion. So how many of those leads are going to convert into customers? And Some factors that you have is into how many do convert into customers. Some vehicles will give you a lot of price shoppers, a lot of kind of tire kickers, and not close very high. Internet's a great example of that. Internet will generate a lot of leads from my experience, but maybe not so many of those leads will close. Radio is another example. When we do radio advertising, we hear the phone ring, we get a lot of people inquire, but how many actually convert? That being said, if we do referrals from neighbors, they close at a very high rate. So you've got to look at how likely are those leads to convert into sales. The other piece of the puzzle is how good are you at closing? You can control your cost per sale based on how good your people are at closing the lead. And if you get really focused on driving your lead conversion so that instead of closing 1 out of 5 deals, you close 1 out of 3 deals, obviously that's going to drive your cost per sale down. So let's look at this example of $33. If I closed an average of 1 out of 3 sales in my Valpak leads, remember my Valpak, I spent $330, I got 10 leads, so that's a $33 cost per sale, and I closed 1 out of 3. My cost per sale would be $100, and that would be pretty good. But if I only close 1 out of 6, then my cost per sale might be more like $200. And so you can understand how your conversion rate is going to affect your cost per sale. Ultimately, your cost per sale is going to affect your return on your invested marketing dollars. And if you can control your cost per sale, control your gross margin, and understand how those two things are related, then you can understand how quickly you can afford to grow your business. So let's the key here is to get obsessed. And you've heard me say this before if you've listened to any of my webinars, because I love to use this terminology around being obsessed. When you're obsessed about something, you get better and better and better at it. And so what I'd like to challenge you to do is get obsessed about managing your gross margin. Make sure that your gross margin is appropriate. Make sure your pricing to your customers is appropriate. See if you can test a small price increase and if your customers will tolerate it. My experience is that they will, and if they don't, you always have the opportunity to call those customers back and lower their price and save them. But my experience is that people will not drop you for a 2 to 4% price increase. Look at really understand what your gross margin is and what your contribution dollars are, and then look at your cost per sale and your cost per lead, and focus on what is your most effective advertising vehicles in a cost per lead basis, and which ones convert the best, which give you the best cost per sale. And then segment it out further into what is your best gross margin per customer. So which one of your customers have the best profit margin? And that is going back to your Golden Street strategy and making sure that you're getting neighbors of existing customers. And what I've found is, and this is just a very generic example, but I had a marketing campaign that I did that cost me $250 cost per sale. It got me neighbors of existing customers. I had another marketing campaign they did that got me $120 cost per sale, but got me customers that were scattered throughout the zip code. When I actually analyzed the math, I actually got a quicker return on marketing dollars for the $250 cost per sale than I did for the $120 cost per sale. So it all comes down to the type of customers that you get and how quickly they pay you back. Now, there's another little trick here. Guys will say, I'll give them this whole kind of presentation, and guys will say to me, so, oh, this sounds really great, Barrett. I want to grow my business. I want to grow it fast, but boy, I don't have any cash to get started. I mean, I'm spending every nickel I got just to support my family. And so how can I really afford to reinvest in the company? And that's a great question, and you got to be really careful about how you do this, because you don't want to spend money on things that you don't know if it's generating a good result and then not have money to pay for groceries. I mean, that's a terrible thing, and I don't want to encourage you to do that. That being said, if you can make sure that your core business pays your bills and takes care of your family, then you can actually risk a lot of things when you look at your incremental business. So let's just assume that you're willing to put $5,000 into growing your business. That $5,000 is only going to get you so many sales. But here's the cool thing. If you invest that $5,000 into getting, let's say you had a $200 cost per sale, and $5,000 would get you 25 new customers. But your goal was maybe to get 100 new customers. Well, what do? Well, here's the cool thing about lawn care. If you use that $5,000 in January to get 25 new customers in January, You then send out a prepay letter to those 25 new customers with a discount offer that says, hey, prepay for your bill and save 10%. My experience is that you'll get anywhere from 20 to 40% of those customers will prepay you. If you can get 20% of those customers to prepay you, you just generated 25 new customers. Average revenue per client, let's just say, is $500. That means you've just generated $12,500 in revenue. You've now got 20% prepay at $12,500. That gives you 20%, 12,500 is 2,500 bucks. So now you've got an additional $2,500 to put back into marketing in February. Now, if it was a 40% prepay, which I've seen happen, I actually had that in my own business. We had to get obsessed about it to get it there, but we got our customers, and here's how we did it. As soon as we sold the deal, we would say to the customer, prepay or auto pay, which do you prefer? Now, they already said yes. They've already said, sign me up. When can I get started? We then say, okay, great. We deal with prepays and auto pays. That's how we bill our customers. We don't, leave a check and let you pay when you feel like it. And so you give us your credit card, we put it on file, and we'll either bill you 7 days after the service is done automatically to your credit card, or prepay us and save 10%. When we did that close, prepay or auto pay, which do you prefer? Our prepay percentage went to 40%. So let's look at that same game plan. You spend $5,000 in January to get 25 new customers, generates $12,500 in revenue. 40% of them prepay. 40% of 12,500 is, and I'm doing this math in my head, so bear with me. It's like $4,800 or $4,900. So let's just round it off and say it's $5,000 because it makes my story really good, and it's just about the same numbers. If you can put $5,000 into sales and marketing, get a 40% prepay number, and then generate an additional $5,000 in prepay revenue, and take that $5,000 invested into more sales and marketing, get another, it becomes a self-perpetuating sales machine that pays for itself over and over and over again. Now, that'll stop working once your cost per sale goes up, once your cost per lead goes up, once your conversion rate gets screwed up, your gross margin gets screwed up. There's variables that do change as time goes on. So you got to make sure you're paying attention to all those variables. But as long as you're keeping everything in control with the numbers we just said, if you were able to get a 40% prepay, literally that $5,000 would be enough to get you as many customers as you wanted. It would just be a matter of how much time does it take for that $5,000 to get you more customers, get the new customers to prepay so that you get the $5,000 back to reinvest it into sales and marketing again. Now, the one negative to doing it this way is that works in January, it works in February, it works in March. It stops working somewhere around April or May. So don't think that that's going to work all season long. The other thing that I see with lawn care guys is they get really excited about this. It usually takes them a month or two to figure it out. So that's January, February. And then right about the time they have it figured out, it's March and they're busy doing applications and they can't market anymore because they can't focus on marketing and production at the same time. And what I would tell you is get obsessed about marketing and don't let it fall off your radar screen in March, because that's when it's going to start to get really good, March and April. If you get all the bugs worked out in January and February, you make a lot of sales in March and April. Come May, turn the marketing machine off, and there's other things you could do to market in May, but this basic strategy starts to run out of steam. Prepay stop working, and you stop getting as many new customers. Your cost per sale goes up. All those things happen. So if your wife's upset because you're working a lot, tell her it's a temporary imbalance, and it's a temporary imbalance just for the month of March and April when you have to do sales, marketing, production, run the kind of whole show. Come May, you can recoup the benefits of growing your business and start to relax and just focus on production. But at the end of the day, don't let the production of the spring slow down your sales and marketing. So I think that's really completes the general concept of using your P&L to grow your business.